Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market ripples, from geopolitics to tech earnings. This video presents a direct informational narration of the source document. So, how does a drone strike in the Middle East ripple all the way to Silicon Valley's biggest tech giants? Today, we're tracing an incredibly volatile trading day as detailed in the source document to understand the hidden connections driving the market.
We've got a packed agenda to get through today. We'll be looking at 6 key areas, starting with global tensions in oil, moving into a shockwave in the Chinese chip market, NVIDIA's circular financing loop, the divergence between hardware and software, some heavy options bets on tech earnings, and finally, why Tesla might be losing its halo.
Let's kick things off with Part 1, Global Tensions and Oil. You know, the U.S. stock market actually opened higher thanks to early morning rumors of a U.S.-Iran ceasefire. It temporarily boosted risk appetite across the board, kind of making it seem like we were in for a smooth, optimistic trading day.
Well, that optimism didn't last long. Right after the opening bell, contradictory information just started flying. By midday, Iran officially shut down those ceasefire negotiations, calling the signals completely chaotic. Then, to make matters worse, by the afternoon, reports started flooding in of drone and missile strikes setting fires at a massive Saudi Aramco facility. We're talking about one of the world's absolute critical crude processing centers in the eastern province. Satellite imagery literally showed thick black smoke plumes, and Saudi officials confirmed intercepting drones originating from Iraq.
But here is where things get really strange. Despite missiles hitting major Saudi infrastructure and all that geopolitical tension, crude oil prices actually fell heavily throughout the day. And even with oil prices and U.S. bond yields dropping, which, usually helps out tech stocks, the Nasdaq still couldn't hold its support levels. It tumbled to a near 3-month low, and it dragged the massive artificial intelligence trade down right along with it.
Which brings us to Part 2, the Chinese UEV shockwave. While the broader market was still trying to digest the geopolitical news from the Middle East, the semiconductor sector got hit by a breaking news report of its own.
A bombshell report from The Information dropped, claiming that China has begun producing its own self-developed extreme ultraviolet or EUV lithography machines. And these aren't just lab experiments. Deliveries are reportedly expected this year to major Chinese chipmakers like SMIC, Huahong, and CXMT.
Now, if you're not familiar, EUV lithography is basically the holy grail of modern chipmaking. It's widely regarded as the absolute most complex and difficult bottleneck technology in semiconductor manufacturing. The market panicked, because if Chinese engineers have actually cracked this incredibly difficult tech, the risk of domestic substitution across the supply chain skyrockets. Basically, they just wouldn't need to rely on Western suppliers anymore.
The reaction was immediate and brutal. Dutch lithography giant ASML saw a 3% pre-market gain instantly evaporate into a sharp drop, and this panic dragged down major U.S. peers like Applied Materials and Lam Research right along with it. Investors were frantically selling off these equipment stocks out of pure fear that full self-sufficiency in China's chip industry could eventually reduce their total addressable market in that massive region to practically zero.
But here's the catch with all this. We've actually heard this ghost story before. A very similar panic happened just this past January. Because of this, many view this recurring EUV rumor as a boy-who-cried wolf tactic, frequently used by Wall Street short sellers. It's incredibly effective, though, because it triggers deep underlying market fears that low-cost Chinese technology could eventually destroy the monopoly pricing currently enjoyed by U.S. tech firms.
Moving on to Part 3, NVIDIA's circular financing loop. In the midst of all this semiconductor chaos, NVIDIA completely decoupled from the broader market. The stock dropped so far below the $200 mark that its total market capitalization was actually overtaken by Apple.
So why the sudden drop? Well, a Wall Street Journal report revealed NVIDIA plans to provide massive financing guarantees, up to $250 billion. Think of it like a bank giving you a giant loan but mandating that you use the money to only buy products from their own store. The report states NVIDIA is helping finance a SoftBank subsidiary to build $50 billion in data centers, while simultaneously discussing $350 billion in chip purchase financing for partners like OpenAI. While this absolutely accelerates AI development globally, it's making the market very nervous about a potential circular financing loop. The source document notes that since 2022, there have been over $540 billion in similar transactions. So investors are naturally asking, is this organic AI demand, or is it artificial, financed AI demand propped up by NVIDIA's own money? If AI deployment underperforms expectations, this kind of deep financial entanglement could pose a massive systemic risk to the entire sector.
This brings us to Part 4, hardware versus software divergence. While hardware and chip stocks were taking a massive beating, we saw a fascinating split in the broader market, with software stocks actually rising.
Take ServiceNow, for example, which saw a solid 6.9% increase on this exact same day. The big takeaway here? Companies that can prove AI is genuinely driving software revenue are seeing sustained gains. We're seeing a clear shift in investor appetite, rewarding real, tangible software revenue over purely speculative hardware momentum.
Looking ahead to see where things might go next, let's dive into Part 5, Tech Earnings Options Bets. How exactly are investors placing heavy, specific options bets ahead of the upcoming major tech earnings reports?
For hardware companies like SK Hynix, traders are expecting massive volatility. They're fearing up to a 10.9% post-earnings swing. The options market is showing a put-to-call ratio of 1.7 for SK Hynix, which is highly bearish. We're seeing a similarly bearish sentiment for Seagate, sitting at a 1.3 ratio. Basically, investors are buying a lot of downside protection on these names.
But in stark contrast, look at Meta. The options positioning here is surprisingly bullish, with 71.4% call options versus 28.6% puts, which gives it a put-to-call ratio of just 0.4. Traders are betting big on a rally. Why? Well, Meta is trading at a significant discount right now. Its forward price-to-earnings ratio is sitting at 14 times, which is way below its 10-year historical average of 20 times.
And it's not just Meta. Microsoft is also heavily favoring calls with a 0.5 ratio, again trading at a discounted 19 times forward PE. Apple and Amazon are both showing bullish 0.7 ratios as well. What's truly wild is that Apple's bullish sentiment is holding incredibly strong, even though the stock is already up 23.7% this year.
Finally, let's wrap up with Part 6. Tesla loses its halo. Tesla has had a remarkably rough stretch, dropping for 3 consecutive days. And this is happening even as a prominent analyst actively maintains an overweight rating and a $300 price target for the stock.
So what's going on? What we're witnessing is a major structural shift. With SpaceX's independent rise making it the new retail darling, a lot of the retail investor funds that used to flow almost exclusively into Tesla are being siphoned away. This leaves Tesla standing on its own 2 feet, highly reliant on actual auto margins, full self-driving, and real progress on their Optimus robot.
Without that exclusive Elon Musk premium capturing all the attention, it is much harder for Tesla to recreate those massive stock surges driven purely by retail emotion and enthusiasm.
As we look at all these ripples, from sudden geopolitical shifts in the Middle East to financial engineering in Silicon Valley, the final question posed by the source document is this: will the upcoming big tech earnings and the Federal Reserve's rate decision save the AI rally?